Most people don't fail at investing because they don't have money. They fail because they never had a plan. Right now, millions of people are putting their hard-earned cash into stocks, crypto, real estate, or mutual funds, hoping something works, praying the market goes up, and panicking the moment it goes down. Some follow tips from friends, some copy social media gurus, and others jump in late when the hype is already gone. After years of effort, they're left confused, frustrated, and wondering why investing seems to work for everyone else but not for them. The truth is uncomfortable but simple. Wealth is not built by random moves, luck, or intelligence alone, built by following a clear roadmap. Every successful investor, whether they started rich or broke, followed a system that guided their decisions, protected them from emotional mistakes, and kept them focused when the market tested their patience. A smart investor is not someone who predicts the market or chases quick profits. A smart investor is someone who understands where they are, where they want to go, and exactly how to get there. Investing is not gambling, and it's not a get-rich-quick game. It's a long-term journey that rewards discipline, knowledge, and consistency over time. This roadmap is designed to take you step by step, from building a strong financial foundation, to choosing the right investments, to protecting and growing your wealth through different market cycles. You don't need a large salary, insider connections, or perfect timing. What you need is clarity, patience, and a strategy you can stick to, even when emotions run high. By the end of this video, you'll understand how smart investors think, why they make certain decisions, and how you can start following the same path today, no matter where you're starting from. A truly smart investor understands that investing is not something you do with spare money. It is something you build your life around with intention. That's why the journey begins with stability, not excitement. Most people enter the market emotionally motivated by a desperate fear of missing out, social pressure, or the burning desire to escape financial stress. But smart investors do the opposite. They slow down and create control first. Think of the 1990s dot-com bubble. Retail investors were quitting their jobs to day trade tech stocks they didn't understand, fueled by the euphoria of easy money. When the crash happened, those who hadn't built a foundation didn't just lose their savings, they lost their homes. They lacked psychological armor. In the modern world, this armor is your emergency fund. It doesn't just protect your wallet, it protects your decision-making. Imagine two investors, Alex and Sarah, during a 20% market crash. Alex has no savings and a high-interest car loan. When the market dips, he panics because he might need that money for next month's rent. He sells at the bottom, locking in a permanent loss. Sarah, however, has 6 months of expenses tucked away in a boring high-yield account. She sees the same 20% crash and does nothing. In fact, she might even buy more. Sarah didn't win because she was smarter. She won because she planned for chaos in advance. Debt must be treated with brutal honesty during this foundation phase. High-interest debt, like credit cards averaging 20 to 25% APR, is the mathematical inverse of wealth building. If you are investing in a stock market that historically returns 10% while carrying debt at 20%, you aren't investing, you are subsidizing your own bankruptcy. Smart investors remove the weight before they start the climb. They set specific, time-based goals, because money without purpose creates impatience. When you know you are investing for a retirement 20 years away, a bad week in the news cycle becomes irrelevant background noise. Once stability is established, the smart investor transitions from a saver to a student of money. They realize that markets are not just spreadsheets of numbers. They are massive, breathing ecosystems of human emotion. To succeed, you must understand behavior more than math. Consider Sir Isaac Newton, one of the smartest men to ever live. He lost the equivalent of millions of dollars in the South Sea bubble. His conclusion: I can calculate the motion of heavenly bodies, but not the madness of people. Smart investors learn how markets react to fear and greed. They recognize that a market crash is often just a liquidity event, where panicking people sell what they have to for whatever they can get. Education at this stage teaches you to choose assets you can actually hold through the dark times. Stocks are powerful, but they are volatile. Real estate offers cash flow but requires management. Smart investors don't chase what's trending on Reddit or TikTok. They build a circle of competence. They ask, what can I survive, rather than how much can I make? This leads to the most critical phase, execution. This is where the crowd falls away. Most people believe investing is about making one great call, finding the next Amazon or Bitcoin early. In reality, wealth is built through the sheer boring monotony of systems. Smart investors automate their contributions. They use dollar-cost averaging DCAA system, where you buy a fixed dollar amount of an asset on a regular schedule, regardless of price. Let's look at the lost decade 2000 to 2010. If you had invested a lump sum in the S&P 500 in 2000, your return by 2010 would have been essentially zero. However, if you had consistently invested every month during that same decade, buying more shares when prices were low and fewer when they were high, you would have come out significantly ahead. Consistency removes the timing risk that destroys most portfolios. Diversification is the next pillar of execution. It is often called the only free lunch in finance. It isn't about owning 100 different things. It is about owning things that don't all move in the same direction at the same time. If you own 5 different tech stocks, you aren't diversified. You are concentrated in one sector. A smart investor balances high-growth equities with defensive assets like bonds, gold, or real estate. They don't need every single investment to be a home run. They just need the portfolio to survive the innings where the world feels like it's ending. As wealth begins to compound, the focus shifts toward preservation. Success itself is a risk because it breeds overconfidence. The legendary investor Ray Dalio often speaks about the all-weather approach, preparing for 4 economic seasons: rising growth, falling growth, rising inflation, and falling inflation. Smart investors recognize that inflation is a silent tax. If your money is sitting in a 1% savings account while inflation is at 4%, you are losing 3% of your life's work every single year. Protection also means optimizing for taxes and fees. A 1% management fee might sound small, but over 30 years, it can eat up nearly 25 to 30% of your total terminal wealth due to the loss of compounding on those fees. Smart investors use low-cost index funds and tax-advantaged accounts like 401 kiloseconds or ISAs to ensure they keep the lion's share of their growth. Ultimately, the roadmap ends at freedom. This isn't a number in a bank account. It's the point of exit velocity. This is when your assets generate enough cash flow through dividends, interest, or rents to cover your lifestyle. At this stage, work becomes a choice rather than a necessity. The smart investor doesn't seek to beat the market for the sake of ego. They seek to fund a life of autonomy. The beauty of this roadmap is that it doesn't require a high IQ. It requires high EQ, emotional intelligence. It requires the humility to start small, the discipline to stay consistent when the news is screaming the sky is falling, and the wisdom to protect what you've built. Those who follow this path don't just build wealth. They build a fortress of resilience and a legacy of independence. They stop working for money and finally allow their money to do the heavy lifting for them. Smart investing is not about finding the perfect stock, predicting the market, or getting rich quickly. It's about building a system that works, even when motivation fades and emotions rise. The roadmap you've just seen isn't reserved for the wealthy, the lucky, or the highly educated. It's available to anyone willing to be patient, disciplined, and consistent. You don't need to start big, you just need to start right. Time is the greatest advantage you'll ever have in investing, and every day you delay is a day compounding works against you instead of for you. The market will test you, distract you, and scare you. But if you follow a clear plan, those moments become opportunities instead of obstacles. Wealth is built quietly, often slowly, by people who stay committed when others give up. The goal isn't just money, it's freedom, peace of mind, and the ability to make choices without financial fear. If this roadmap gave you clarity or changed how you see investing, like this video, follow for more real-world money education, and comment where you are on your investing journey. Share this with someone who needs direction, not hype. Thank you for giving me your time, and remember, smart investing isn't about doing more. It's about doing the right things for long enough.